under the derivative contracts, there are three types of contracts. You have a forward contract, a future contract, and an option contract. Specifically diving into option contracts, you have a call option contract, which gives the holder the right but not the obligation to buy the underlying security at a future date at a pre-decided price. On the other hand, under the put option, the holder of the option gets the right to sell the shares at a not specifically the shares, but any underlying asset at a pre-decided price. Now, under the option contract, it is the holder who has the right to exercise the contract. The writer of the option has the obligation to perform the contract whenever the holder demands him to do so. So, for this right, the holder has to pay a premium to the writer of the option. This is what we have done, we have covered till now. Under combination strategies, uh, holder of an option contract and investor might combine his position on the stock with call option, put option, or both the options, either as the holder or the writer of the option. Okay, and in each of the strategy that we study, the aim of the investor is to hedge the risk while making some profit if possible simultaneously. So we start with the first combination strategy, which is the simplest of all, that is a protective put. You go long on a share. Since we are talking about stock options, you go long on a share, which means you are buying a share, but at the same time, you want to safeguard yourself against any possible decrease in the price of that share. Okay, why are you buying a share? Because you are expecting that in the future the price of the share in the market will increase, but there is a possibility that the price of the share might fall. So to protect yourself against that possible drop in the price, you purchase a put option also. The benefit is that if you see an increase in the price of the share in the future, then you are comfortably selling the share at profit and you let the put option lapse. The only loss will be the premium that you have paid on the put option to the writer. However, if the price of the share, the spot price of the share falls, then by exercising the put contract, you will be able to sell the share at a decent price, at a price which will be above the spot price. Okay, so to understand it better, we move to an example. So the example is here. Assume an investor has purchased 100 shares of XYZ Limited at rupees 50 per share. Okay, so 100 into 50, the price paid for this contract was rupees 5,000. Now, the shares were obviously purchased when the investor was bullish on the security. Now, the price is consistently increasing in the market. It has increased to 65 and you are expecting it to increase further to 70. So you're waiting to sell it at rupees 70. Now there is a risk in your mind that the price of the share might fall in the future. So what do? You When the stock is trading at 65, you purchase a put option contract on the same share at 62. 62 means that the exercise price exercise price is rupees 62, and for that you are paying a premium of rupees 3 per contract. Okay, now you have entered into a put option contract for selling 100 shares. So which means you are paying a premium of rupees 300. Okay. Now whatever be the situation in the market, you can comfortably sell these 100 shares at rupees 62 per share. Now there are two possibilities. Say assuming this is an contract. European contracts can be exercised only at the expiry date, while American options can be exercised either at expiry date or any time before the expiry date. Now, assuming that on the expiry date, your stock indeed reaches 70 rupees, which was your target also. Now, on the share, you have made a profit of rupees 20, because you bought the share for 50 rupees. Now it is selling for 70 rupees. You have a total of 100 shares. So your net profit on this combination strategy will be 70 minus 50 into 100. Since the market price is higher than the exercise price, you let the put option lapse, but you have paid 300 for this put option contract. Hence, your net profit comes to rupees 1700. So, this will be the net profit if the spot price in the market is greater than the exercise price. Okay. Now there can be an opposite situation wherein the price falls below 62 rupees. So here you can see, say the price of the share falls from 65 to 55. You had apprehensions about the global market, which turn out to be true. So now what you do is you are facing a situation where the spot rate in the market is lower than the exercise price. This is the perfect time to exercise the put option, while others in the market will be able to sell the share at 55. You are able to sell the share at 62. While others in the market are selling it at 55, you are able to sell it at 62, which means as compared to your purchase price, you are still making a profit of 12 rupees on each share minus the 300 premium you have paid. So now your net profit from this combination strategy comes to 900. So in either of these situations, you are making a profit because of the combination strategy. So looking at the payoff, this is what the payoff of protective put looks like. Without protective put, if you are just holding a stock, you can see the blue line. You face the possibility of unlimited profits and unlimited losses. But with a protective put, you are able to cap your losses while there is a possibility of unlimited profit. This is the payoff intrinsic value of the protective put option. So I hope protective put is clear to everyone. We now move to the second combination strategy, a covered call. Okay, so covered call is a situation where the investor is having a neutral view on the stock. The investor is long on a stock, he has purchased a share, but what he expects is that there wouldn't be much price movement in the share. So, one thing is to sit on the share with this assumption. Second is when you want to take advantage even of this neutral perspective. What you can do is you can hold the share while simultaneously writing a call option. Why would the investor write a call option? By writing a call option, I mean that the buyer can ask me to sell the share at a pre-decided price in the future. Why will you write a call option? Because somewhere you know that there won't be much fluctuation in the price in the spot rate and the buyer won't be exercising this call option. The benefit of this would be that you can pocket the premium on the call option that is being sold. So you have purchased some shares and now you want to make profit on holding those shares also. So for that you are selling a call option in the expectation that this option contract won't be exercised and you will be able to safely pocket the premium on the call option. Now this strategy works only when you have a neutral view of the market. If you are bullish on the market, you are expecting an increase in the price of the share, don't write a call option. It is just better to just hold your position in the asset. On the other hand, if you are bearish on the market, you are expecting a fall in the share price, it is better to sell the shares today rather than writing a call option, because even if you are pocketing the premium, there will be a loss. So when you feel that the price fluctuation will be very minor, somewhere around the exercise price, then this strategy will help you make some extra profit. Let us see how it works. We take a simple example. You own 7,000 shares of a company which you have bought at rupees 130. Now you see that over a period of time, you see that the price is fluctuating in this range and the maximum price that you can reach with this share is rupees 135 per share. You enter into the derivative market and you write the call option on this share at rupees 4 per share. So 4 per share is the premium that you are making. The exercise price on this option contract is 135 and you are earning, by writing the call option, you are earning rupees 28,000, which is 4 rupees per share on the 7,000 shares. Now, if the stock closes at or below 135 on expiry. Okay, now say for example the share closes at rupees 135 on the expiry date, then what will be the scenario? You purchased this share I think it's not fully visible, the slide. You purchased this share for 130. You are able to sell it for 135. So there is a profit. I'll just write it here. So say the spot rate in the market on expiry is 135. Your exercise price was also 135. So your call option contract won't be exercised by the buyer. Okay. Or even if we assume that it is exercised, you are not making any loss on the contract. So now the profit or payoff will be you purchased these shares for 130. You are able to sell them for 135. So 5 rupees per share is the profit. 7,000 शेयर्स पे 35,000 का आपको प्रॉफिट हो जाएगा प्लस 28,000 that you have earned by selling this call option contract. So that makes a total of 63,000 as the net profit from the contract. So you are able to enhance your profit by 28,000, which was the premium on the call option writing. On the other hand, if the say the spot rate in the market is 132 or 130, so even then, say it is 132, the exercise price was 135. Again, call option contract won't be exercised. You still make a profit of 2 rupees on each share, 14,000. 2 रुपीज का कैसे आपने 130 का शेयर खरीदा और 132 का आप उसको मार्केट में सेल कर पा रहे हो, तो 14,000 ये प्रॉफिट हो जाएगा plus the 28,000 on the call option contract, which makes a profit of 42,000. So under the situation of the price neutrality turning out to be true, that is exercise price equal to spot rate or a minor fall in the price, you are still able to make a good profit through this combination strategy. However, the problem will arise when the spot rate in the market increases to 140. Okay. Now in this scenario, your profit will now be limited. Had you sold the shares directly in the market, you could make a profit of 10 rupees per share and there wouldn't be any requirement of selling these shares at 135. ओके, तो आप डायरेक्टली 10 रुपए का प्रॉफिट बना सकते थे अगर आप इस कॉम्बिनेशन स्ट्रैटेजी में एंटर नहीं करते. बट नाउ सिंस यू हैव sold the call option contract at 135, you will be selling these shares at 135, so your profit has been limited. 5 रुपीज का अभी भी आपको प्रॉफिट होगा हर शेयर पे क्योंकि आपने ये शेयर्स खरीदे थे 130 पे. यू आर स्टिल अर्निंग अ प्रीमियम ऑफ 28K and your total profit is coming to 63,000, but your possible profit has declined. Okay, so in either of the situations with a combination strategy, you are making a net profit. Okay, you are limiting your losses, but in this case, your profit is also being limited. So the payoff for such a strategy looks something like this. Upper limit of the profits has been capped because of writing the call option contract. To explain it further, we take one more example. Have a look at this slide. Suppose an investor holds 100 per share ABC, and he is also selling the call option on ABC Limited at 105. So again, same strategy, the covered call strategy. If the price moves above 105, the upside gain is capped at 5 rupees because he has sold the call option at 105 plus 1 rupees premium which he has pocketed. On the other hand, if the price falls, then the premium becomes the extra earning for the shareholder, for the investor. Is the covered call clear? If there's any question, please ask, because this was different from the simple option contract which we have done. Okay, so talking about the payoff, जो आप intrinsic value हम बात करते हैं, उसमें मैंने पहले भी बताया था, आई रिपीटेड, इंट्रिंसिक वैल्यू में कभी भी आप प्रीमियम की अमाउंट को कंसिडर नहीं करते. तो इंट्रिंसिक वैल्यू कैसे कैलकुलेट करोगे? स्पॉट रेट मार्केट में कम है एक्सरसाइज प्राइस से, तो आपको स्टॉक के ऊपर स्पॉट रेट मिल जाएगा, आपकी कॉल ऑप्शन एक्सरसाइज नहीं होगी, तो आपका टोटल जो intrinsic value है from this covered call is ST, which is the spot rate in the market. On the other hand, if the spot rate is greater than the exercise price, your call option will be exercised and you make a loss. वो loss क्या होगा? ST minus X, and your payoff from the this option strategy will be X, that is the exercise price on the contract. Okay, so we'll take up one more strategy after protected put and covered call. We take up the third strategy, which is a straddle. So a straddle is one of the safest combination strategies wherein along with a position in the contract. So a position on the underlying security, say you either go long on the shares or you go short on the shares, you enter into two option contracts simultaneously. That is a call option and a put option. आप दोनों contracts में enter करते हो with the same strike price, same expiry date and paying premium. Okay, now this again can be the case where you buy both call and put option or you sell both call and put option. तो पहले concept explain करने के लिए let's take the simplest case that I am long on a share, I have purchased a share. I don't know whether the price of this share will increase in the future or will it fall in the future. So to safeguard myself, अगर increase होगा price future में, तो उसके लिए I am buying a call option, and if the price, there is a possibility that the share price will fall, I am buying a put option. Okay, so I am trying to cover my position, I'm trying to hedge myself to the maximum extent possible. So if the market moves up, you have a call option. If the market moves down, you have a put option. Again, This strategy can be worked, say, with a long position in the share, or you don't hold the share right now, but you enter into a call and put option on that share simultaneously. Okay, so what happens is that you have safeguarded yourself by entering into a call and put option as the holder. शॉर्ट्स इसको लॉन्ग स्ट्रैडल बोलते हैं, जहां पर आप कॉल और पुट दोनों को परचेज कर रहे हो, और एक पोजीशन होती है जहां पर आप दोनों को सेल कर सकते हो with the same strike price and expiry date. That is a short straddle. आप सेल कब करते हो ऑप्शन कॉन्ट्रैक्ट को? व्हेन यू वांट टू अर्न एक्स्ट्रा थ्रू द प्रीमियम ऑन द सेल. So let's first take up long straddle in detail, and then we'll take up short straddle. So let's start with an example. Long straddle is when you are purchasing both the call option and the put option on the same share. Okay, so in this case 7600 call option, तो एक्सरसाइज प्राइस कॉल ऑप्शन कॉन्ट्रैक्ट का 7600 है, while of the put option contract is also 7600. Both have the same expiry date. For call option you are paying a premium of 77, while for the put option you are paying a premium of 88. तो आपको शेयर्स चाहिए, अभी हम अज्यूम कर रहे हैं हमारे पास शेयर्स नहीं है, तो अगर आपको शेयर्स चाहिए, प्राइस इंक्रीज होगा मार्केट में, यू कैन परचेज देम एट 7600, and if you are seeing a drop in the price of the share, you can still sell it at 7600 irrespective of the spot rate in the market. दोनों का प्रीमियम मिला के यू हैव पेड a total amount of rupees 165 on this long straddle strategy. Okay, so now the trader, now the investor is not worried in which direction will the market move. So let us see what can be the possibilities in the market. First option or first scenario possibility is that the spot rate in the market on the date of expiry of the option contract is 7200. आपके पास कॉल ऑप्शन भी है, आपके पास पुट ऑप्शन भी है, स्पॉट रेट जो है मार्केट में वो एक्सरसाइज प्राइस से कम है, तो जहां पर बाकी लोग अब शेयर सेल कर सकते हैं 7200 में, यू कैन सेल दी शेयर्स एट 7600. So you will let the call option contract lapse, but you will exercise the put option. You will sell the shares at 7600, making a profit of 400 on the strategy, but you have paid a premium. You have paid a total premium of 165 दोनों ऑप्शन कॉन्ट्रैक्ट पे. तो अब आपका जो नेट प्रॉफिट होगा वो होगा 400 का प्रॉफिट minus 165 rupees paid as the premium for this long straddle, and you are making a profit of 235 rupees from this contract. Second possibility under this contract is that the spot rate in the market on the date of expiry is 7435. Okay, again spot rate is lower than the exercise price. You will let the call option lapse. You will exercise the put option. पर इस पोजीशन में you will be at break even. ब्रेक इवन क्यों होगा? क्योंकि आप को शेयर आप सेल कर रहे हो 7600 में, when others are selling at 7435, so you see you are making a profit of 165, but you have also paid a premium of 165 on this strategy, so you reach a situation of break even, that is no profit, no loss. The third possibility, third scenario is when the option contract expires at 7600. ये आपके लिए लॉस सिचुएशन है, क्योंकि आपकी दोनों ऑप्शन कॉन्ट्रैक्ट, ना कॉल ऑप्शन का कोई फायदा है ना पुट ऑप्शन का, क्योंकि आपका स्पॉट रेट जो है दैट इज इक्वल टू द एक्सरसाइज प्राइस, तो आप दोनों ही कॉन्ट्रैक्ट्स को एक्सरसाइज नहीं करोगे एंड योर 165 becomes the loss on this strategy. Okay, so this is the most dreaded situation for the investor. Maximum loss जो हो सकता है इस कॉन्ट्रैक्ट पे वो 165 रुपीज का है. After that, there may be a situation when the market price moves above the exercise price. इन केसेस में आप कॉल ऑप्शन कॉन्ट्रैक्ट को एक्सरसाइज करते हो, 165 का प्रॉफिट हो जाएगा, आप शेयर्स परचेज करोगे 7600 पे, यू एक्सरसाइज द कॉल ऑप्शन, यू लेट द पुट ऑप्शन लैप्स, so your profit will be 7765 minus 7600 minus 165. This is the premium paid. So you are again in a break even situation. तो दो पॉइंट्स पे आपका ब्रेक इवन आया है. वन, when the spot rate in the market was strike price, the spot rate in the market was lower than the exercise price by the amount of premium. So 7600 minus 165, and second is when the spot rate in the market is higher than the exercise price by the amount of premium, 7600 plus 165. तो इस रेट पर भी आपका जो नेट पे ऑफ है दैट विल बी 0. And the last scenario is that you reach the market reaches a good high and the spot rate is much higher than the exercise price. Your call option is in the money. 7600 का कॉल ऑप्शन है, मार्केट प्राइस 8000 है, 400 रुपीज का आपको प्रॉफिट हुआ है, 165 आपने प्रीमियम पे करा है, so now your net profit is 235. We have seen 5 scenarios. The worst being spot rate is equal to exercise price, 2 cases where you are breaking even, and then 1 case where you are exercising the call option contract and making a profit of 235, and the last case where you are exercising the put option and making the same profit. So when you look at the payoff from this contract, you see this is the payoff diagram. So a V is what you see. जो रेड वाला पोर्शन है दैट इज दिस पोर्शन, जो मैक्सिमम लॉस वाला पोर्शन है वो तब होता है व्हेन योर ऑप्शन कॉन्ट्रैक्ट इज एक्सपायरिंग ATM at the money 7600 स्पॉट रेट है और 7600 ही एक्सरसाइज प्राइस है। ओके, दो ब्रेक इवन है जहां पर आपका नेट प्रॉफिट जीरो है, एज आई एक्सप्लेन यू। अदरवाइज यू कैन हैव अनलिमिटेड प्रॉफिट, द ग्रीन पोर्शन। Okay, so this is how a long straddle looks like when you are buying both the put and call option at the same exercise price and same expiry date. Okay, we'll stop here.